Pricing power has been a big topic in the stock market recently, especially as we started to see the market start to rise again. But even though there's a lot of talk about pricing power, I don't think many people actually understand what pricing power looks like when you start to talk about companies and their earnings report. So in this video, let's discuss what pricing power is and take an example of two different companies and see which one has pricing power and which one doesn't. And we also discuss some more characteristics that do make up a company that does have pricing power. So what is pricing power? Really what pricing power is that it's pretty much a company's ability to be able to sustain margins even in a time where their pricing power or their ability to raise prices or maintain prices for all companies throughout the market start to go down. This is usually times of recession or high inflation. I think two companies that are a really good example of what pricing power is and isn't is McDonald's and Tesla. And I know some of you probably already know which one's the company that actually has pricing power and the company that doesn't. But still, let's go through these companies' recent earnings calls and really start to dissect what makes these companies have pricing power or not have pricing power. So let's start with the McDonald's earnings call. So in their earnings call, they're asked about their recessionary concerns in not only the US, but also Europe as well. And their CEO stated that they believe they're starting to see softening in the US. And this is mostly based off of the decrease in units per order that they have recently seen at their stores. And what a decrease in units per order means is like maybe someone ordered a hamburger, but they didn't get fries with it. They also stated that they are starting to see more resistance in their pricing, and it's even more than what they initially projected when they were making their forward-looking guidance. So that is very concerning, especially if we're looking at companies that have pricing power, because companies that have pricing power don't necessarily need to lower their prices. Or if they do lower their prices, it's because they want to stimulate growth of their company. So they go on, and the CFO follows this up by saying that the company has recently started to take more of the inflationary increases to their margin. And it was said basically in like this corporate gibberish. But anyways, what they're saying is that because they can't pass on the continuing inflationary growth to prices to their customers, they now have to take it in the margin, which isn't a good sign, especially if we're looking for companies that will be able to sustain their margins. They can grow their businesses during a recession. And what they said about taking inflation to the margin is vastly different from what they've said in previous quarters, where they have been able to pass on those higher costs directly to customers and actually not seeing a slowdown in their business. So as a follow-up question, the company was asked about the consistency of traffic and pricing in their previous quarter. And I thought the CFO's response was very interesting to this. They're seeing a consistent growth of both traffic and pricing. And then they go on to say that they're positioned from a value and affordability standpoint, which is kind of concerning again if you're looking for a company that has pricing power, because they shouldn't really be taking the position of affordability and value. They should be taking the position of, oh yeah, we have the ability to increase our prices and to increase our margin. And this was somewhat contradictory to what we talked about earlier, where they were talking about that their per ticket size is fallen, but they say they are affordability play, which means that they may have to become more of an affordability play if they want to keep their per ticket size up, at least from terms of items ordered, not necessarily from terms of, which again is another show that this company does lack PP. So when they were asked about the projections on inflation and how that will play out in their operating margins, they stated that they believe inflation is overall on a downtrend and that commodity inflation will fall sharply, but labor will stay elevated and probably flatline. And this will help them keep margins intact overall. Now, personally, I don't really know about all that, given that they just stated that customers are starting to push back on price. If that plays out, then they may have to cut prices instead, like what I just previously said. So then they were asked about consumer pushback on prices that they mentioned earlier. And the company responded by saying that they need to stay very disciplined on pricing and that they can't get too aggressive with passing on these inflationary costs to their customers. Which again, to me, essentially says that they don't have any room to raise prices anymore. Which in the case of a company like McDonald's, basically means they have no PP or pricing power. Let's move on and let's look at the Tesla earnings call. And in the Tesla earnings call, they were asked about their auto gross margin guidance. For those of you who may not follow Tesla, they did have a over the past couple of quarters, they have been aggressively cutting prices on their cars. This is mostly in response to the high financing rates that come with car ownership nowadays, especially after the Federal Reserve has hiked rates. I think it's like 20x over the past year. But anyways, this has obviously affected their margins and they have had to cut prices. So they're asked during their earnings call about auto gross margin guidance. And they said that they have been able to ramp Austin and Berlin factories to a point where it actually has led to lower cost per car, which has led them to be able to give a little bit more wiggle room to customers when it comes to the purchase price. They also expected more softening commodity cost, and that lower OPEX they can also pass on those savings to consumers as well. When asked about possible full self-driving price cuts, Elon Musk responded by saying that an autonomous vehicle has much more value than the cost that FSD costs today. So, and essentially you're buying almost a call option on full self-driving by buying it today instead of in the future once it's fully refined. He also said that FSD allows them to cut vehicle prices now and monetize those vehicles on the back end with FSD, which in my opinion shows that this company has a lot of pricing power, because it's not necessarily so much how much margin they make at the sale, how much money they can make over the whole life of the vehicle, which they believe is a lot with all the different features that they have to offer with their cars, which is a strong sign of pricing power. So when we compare these two companies, both companies did discuss how they're finding headwinds when it comes to pricing. With McDonald's, we're starting to see more and more customers start to reject any more pricing increase. Whereas with Tesla, you're starting to see volumes actually didn't decrease because they did cut prices. Volumes actually end up growing. But when you consider the fact of how much they cut prices, volumes didn't grow enough to make up for revenue. And they did end up having to take out the margin. But both companies also discussed how commodity prices coming down over the span of this year will help them a lot with their margin. And you can almost say that both companies are betting that this will help out their margin numbers in the long run. Some of the differences with each company is that when you look at the margin of each company, it seems to be a little bit different of a situation. So when it comes to McDonald's margin, they're sitting at around about 13%, and that's excluding franchising. Which, if you know anything about McDonald's, that's where they make a bulk of their money. The company-owned stores don't really make that much money, but the franchise-owned stores, through all the franchising fees and profit shares and things like that, McDonald's actually makes quite a bit of money off of that. Now, when we look at Tesla's margins sit somewhere around 18% gross, and that's just considering the auto business. So another difference between these two companies is the customer's future value. You know, McDonald's they get their value mostly from their customers just coming back. But as we've seen is that their problem isn't necessarily customers coming back, but it's getting them to spend just as much money, if not more money, on their visits. Whereas with Tesla, they're able to sell customers once and then be able to get more revenue from their customers throughout the life cycle of their cars, which is a very long time. And then when we look at commodity prices, McDonald's is starting to see a slowdown in inflation growth of their commodities, whereas Tesla is actually seeing the prices of their commodities go down, which is more of like a deflationary movement, whereas we're starting to see McDonald's commodity numbers start to just flatten out. So I think that this pretty much sums up that Tesla is a very strong price and power play. And then McDonald's is not the strongest price and power play. Some of the characteristics when it comes to companies that have price and power is that generally these companies tend to have unique products. I think, in my opinion, some price and power stocks are companies like Tesla, Nvidia, TSMC. I think that these companies have moats that are very unique to them, and that gives them a lot of ability to adjust pricing however they like. But granted that with this uniqueness also comes some risk. If the market that buys their products doesn't value their products as much as the stock market does, then you may be in a situation where you can actually lose a lot of money if the moat is gone. But it can also lead to really strong returns if that does play out and they do innovate for the future. And also because of their uniqueness, they also tend to have much higher valuations compared to some of these staple companies like McDonald's. This video isn't necessarily personal financial advice for anyone because obviously I don't know everyone's situation. But for me personally, I'm trying to focus more on these kind of price and power companies, and more specifically, companies that are profitable and have price and power. Because companies that are profitable are obviously less risky. When a company is making money, it's very difficult for them to go out of business. Whereas a company that doesn't make money, they have a much higher chance of going bankrupt, especially if they can't find investors to fund these losses. And I believe that companies that are profitable have more money to invest in growing their businesses. And really what the stock market is valuing is the projected growth of these businesses. That's pretty much the fundamentals that the whole stock market is based off of. So for me, sometimes I'll buy unprofitable price and power plays, but I usually tend to keep them a very small portion of my portfolio. And if they ever double in a very short amount of time, I usually just sell them and take the win. That's basically all I got for you guys. I hope that this gives you a much better understanding of what price and power is and what it looks like when you are reading through earnings calls or looking at different companies trying to determine if they have price and power or not. Thank you so much for watching, and I'll see you in the next video. Peace.